Recording in progress. There we go. Okay. Well, come on board, everybody. As mentioned, I know we've got people from all over the world, so welcome on board to everybody from wherever you are coming. Let us get ourselves going straight away. I see there are still quite a few people that are going to be joining us, but I think the time is now, so let's get going straight away. Okay. Let me share the screen with you. Okay. Okay. Can everybody see that? Okay. So first and foremost, okay, let's just get ourselves a little bit of a perspective of where we are in terms of the Zoom classes, in terms of where we are in terms of the studies. Okay. So if you have a look at what our topic for today is, guys, topic 2 and topic 3. Okay. Now, just in terms of, just for those that are perhaps new on our Zoom class, on our Zoom call for today, just by way of introduction, just a little bit of what is the Zoom class? We get asked a lot, what do you do in the Zoom class? What can we expect from the Zoom class, etc., etc. Okay, so the Zoom class, okay, one of the fantastic things that I like about the Zoom class is it gives us a bit of structure. What that means is that by the time you come to today's Zoom class, okay, you know that you have covered that today's Zoom class, particularly, we are covering topic 1 and topic 2. What that also means, hopefully it's not bad news for anybody, that by now you should have covered topic 1 as well. Okay, so as we stand today, 17th of November, 2024, okay, the suggestion, and I really say it as a suggestion, because my intention is not to make anybody anxious if you haven't covered it. If you haven't covered it and you are not where we are today as a class, it's not a problem in the world. And I'll tell you why it's not a problem. And I'm even going to tell you how to catch it up. Okay. We've got lots of ideas for you guys. But in terms of the Zoom class, typically speaking, for example, we say there's a Zoom class there on the 17th of November, and I want you to come to class having covered topic 2 and topic 3. Okay. That'll give you a fair measure of structure to know exactly where you need to be in terms of your studies. Okay. And then if we look forward, guys, there is no class next week. There's a class the week after. I don't know what that would be, probably 1st of December. Okay. And then again, so you know, from the time we finish today's class till we meet again, 1st of December, okay, we move into topic 4. Okay, so it gives you a fair measure of structure. When you come into class, like for example today, had you been on time or maybe even on time, I'm hoping most people are in line with the timetable, okay, then you'll know that today's discussion is going to center around topic 2 and topic 3. Okay, so that's and again, in terms of what we do in the class, okay, is we handle what you guys want us to handle. So for example, I say to you guys, listen, 17th of November, we're going to meet, we're doing topic 2, we're doing topic 3, okay. Please, before that time, yesterday, today, having gone through the material, are there areas you would like me to clarify? Are there questions that you have? Are there areas that you want me to look at with you? Okay, and that's the purpose of these Zoom classes. Typically, we go on for about an hour and a half, 90 minutes, 90 minutes. That's just generally what we find people have got in terms of their Zoom capacity. Okay, and we discuss those particular topics. Okay, so today's topic, of course, guys, is topic 2 and topic 3. Just for those that perhaps are just starting the program, no stress at all. Okay, what was topic number 1? What is topic number 1 that we are hoping people have covered or is going to cover quite soon? Okay, that was institutional asset owners. That was topic number 1, guys, and we always get asked. Yeah, I don't think he's on our call together with us. We've got one candidate who wants to know what's the most difficult of the 9 topics in CAIA level 2. Okay, all I can tell you, it's not topic 1, not a difficult one at all. That's not one of the difficult ones, guys. So it's a good one if you haven't yet done topic number 1 and you do need to catch up. Put it aside. Okay, remembering, guys, that we as a class, do take a bit of a break mid-December till about the first week of January. It's about three and a bit weeks. Okay. And that time is meant for two things. Number one, have a bit of a break, have a bit of a holiday. I know people have worked hard this year. And number two is if you are a little bit behind, do use that time then just to catch up and make sure you are on track with where we all are as a class. Okay. But so that talks about topic one. Topic two and topic three are what we're going to be covering today in class. Okay. And just to let everybody know, we only had one question. Okay. Which will, of course, we will handle. But remember, guys, and it's so important for you guys that are part of the Zoom class belongs to you, and you can ask any questions that you like. I always prefer if you'd ask them a little bit earlier so I can prepare for them. If not, it doesn't matter at all. I will handle them together in class with you. Okay. So, on that note, so we had one question which I will deal with on total portfolio approach, the TPA. But other than that, and it's important also to remember, guys, if you haven't submitted questions, if you're not where the class is for that particular Zoom session, it doesn't matter at all, okay? Because, you will benefit anyway. And you'll see from today's session, what I do is when I don't get specific requests from the class as to what you guys want me to handle, okay, then the Zoom session belongs to me again. Okay. And I find what I believe to be the most difficult sections, the most difficult topics, the areas which I think would benefit people in terms, and we treat it as a little bit of a standalone little section. We can typically cover 2, sometimes even 3 sections, guys. And so it's very worthwhile. Don't write off the Zoom session. If you are not where you need to be for the Zoom session, please still attend. It'll be very, very beneficial for you. Okay, good. On that note, let us have a look at what is in topic 2 and what is in topic 3. So we've discussed topic number 1. We did that last week, guys. If you've missed that, no stress at all. There's a recording available for you. There we go. Okay, topic number 2, okay, and I want to just discuss topic number 2, give you guys a little bit of guidance as to where this whole thing comes from, okay, and it's just if you have a look at the picture that we're dealing with over here, okay, it's important just to get a picture of where the whole of topic 2 comes, because topic number 2 is not it looks new, because if you look at 2024, there was no topic 2 called asset allocation. There was no asset allocation at all as a topic in 2024. Where is it from? Okay, now, as a bigger picture, okay, what we see, guys, is that 2 readings of the 4 come from what we call the models section. So previously in 2024, we had a section that was called topic number 3, and it was called models. And asset allocation process and MVO was in there, and other allocation approaches were in there as well. So it's not new at all. In addition, reading 2.4, which is called active management, okay, also was just harvested from another section in 2024, okay, which was called due diligence and selecting managers. Not a new one either. And I'm just mentioning this for those guys that perhaps are repeating, just to know where everything comes from. So you would find these 2 in the old topic 3 called models. This one came from the old topic 8. And yes, guys, this one, total portfolio approach, that's new. So when you look at topic 2, asset allocation, there's really only one new reading. But just be mindful, if you are using old notes, old material, things like that, things have been moved around just a little bit. Okay. And in terms of topic 2, that is what I want to handle a little bit over here, is in terms of TPA, how it fits in, what is it, okay? And I can hear the question at the back of the classroom, okay, is because it's new, is that what's going to be examined? We don't know. But all I can tell you, okay, it's a brand new topic. Okay, this is the new one. Okay. And what I've done over here for you guys in terms of this, and I just want to we'll spend a few moments then on this in terms of total portfolio approach, is just to discuss a little bit about it, how it fits in, where is its place, why is it necessary, where was it from? Okay, and that's all I'm really going to be doing for topic number 2, asset allocation. We will then move on to topic 3, risk and risk management. Okay, and guys, at any point in time, if there's something else you would like to rather do, if you've studied the material and you say, can we rather, this absolute pleasure. Remember, guys, the session is your session. So this was the one question that we did have on total portfolio approach, a little bit more of a discussion how it fits in. And that's why I'm going to mention that one first. Thereafter, other than that, guys, by the way, topic 2, in terms of its rating, okay, also not an overly difficult one. Okay, and the reason I say it's not overly difficult because active management, not really difficult. And these two coming from topic 3, people are quite familiar in general. When you talk to people, people are quite familiar with the MVO. The MVO, mean variance optimization model, a very old model, okay, in terms of portfolio construction, and how you construct a portfolio under MVO is generally quite a well-known concept. Okay, so I wouldn't rate topic 2 overall as a very difficult topic. Let's just make sure that everybody out there is awake and alive and ready, because I'm getting tired. I'm not really, but okay, I've been up early. Okay, so you're going to have to do a bit of the work for me today. Okay, and guys, when I talk about MVO as a portfolio construction methodology, I'm checking the chat now. What are the 3 major inputs into MVO? Okay, what are the 3 major inputs? In order for me to run an MVO model, guys, I need 3 inputs. What are those? Okay, I'm going to check my chat. Let's see who's up and about on a Sunday. Okay, what are the 3 inputs? Okay, it looks like we've got some. Okay, let's have a look. Bill, mean, yes, that's why it's called mean, isn't it? Variance, yes, and correlation as well. Good. Okay, because what do we do, guys? Remember, just by way of just to jump back into a little bit of mean variance optimization, you just remember that we work with a mean. The mean is the return of the. Remember, what are we trying to do? We are trying, and always get your bearings with you. What are we trying to do? We are trying to create what? A portfolio. A portfolio has got what, guys? At least 2 assets. If it's got at least 2 assets, I want the mean, I want the returns of those assets, I want the variance or the standard deviation, or whatever you want to call it, of those 2 assets. That's the risk of those 2 assets. And number 3, I want the correlation. How do those 2 assets relate to each other? And of course, we know what's one of the biggest, and I'll stop after this, I promise, guys. Last question, what's one of the key concepts that we talk about when we talk about MVO and the 2 assets? What am I seeking, guys? What's the word? One word. When I'm looking for the MVO process and my 2 assets, I'm looking for one word. It's a central word that drives MVO. Anyone out there? I'm checking my chats again. Optimization is a good word. Not what I was looking for, but not a bad word, Mark. Thank you. Bill, diversification. Exactly right. Okay, so yeah, that's what we are looking to do. And that's why if you look at the 3 words, mean, variance, and the correlations between those 2 assets, typically speaking, in a good portfolio construction and in an optimized portfolio, what would you look for? Typically 2 assets with differing correlations. And of course, that's why when you talk about alternatives, and this is the central theme that we've brought through with us from CAIA level 1, when we talk about the diversification, optimization, alternative assets, we generally say alternative assets have got a low level of what? Low level of correlation with the traditional assets, stocks and bonds, and therefore it makes a fantastic addition to a portfolio in terms of its diversification benefits. Okay, good. So as you can see, guys, it's not an overly difficult, not an overly crazy section, this topic 2. What I want to talk about briefly, I'm going to stop sharing this document with you, and I'm going to share my the actual notes. So guys, if you've got the notes in front of you, you can pull them out. If not, no stress at all. I do have them in front of you here. Reading 2.2, these are the edge notes, guys. Okay. And reading 2.2, total portfolio approach, TPA. Okay. And what I want to do over here, guys, is just to take a brief look at. I'm not doing all in these brief Zoom sessions. Obviously, I'm not going to go through the notes with you. And everyone said, "Well, why not? Can't we go through all the notes together?" And the reason, of course, not, guys, is because you've got a complete set of notes called the Edge Notes, and you've also got a complete set of videos which covers everything. What we do in these sessions is I pick up some points, or we discuss some points. They do things like that. But in terms of the material in the notes, you've got it all. Okay, so no need for me to just repeat that for you. Okay. Just very briefly, guys, okay, it's a new-ish investment management approach called TPA. And if you look at the words of TPA, guys, okay, look at the word TPA, total portfolio approach. What are we looking at over here? We are not looking at the portfolio as a silo. For example, what would you sometimes find? Let's just say if I got a portfolio over here, and my portfolio might be made up of two components, stocks over there and bonds over there. Okay. It's quite easy, for example, in such a portfolio to have two completely independent teams. You've got your stocks team, you've got your bonds team. They work completely separately. Each one is involved only with securing its specific return and things like that. Came along total portfolio approaches. No. We are now going to look at the portfolio from a total point of view. Okay. And nothing will be added to this portfolio unless in some way or another, we'll talk about that in a second, it adds value to the portfolio. Okay. As a total. Okay. So we move over here. Okay. And we talk about this concept called bucketing, just very briefly. Okay. And bucketing is that what I spoke about before. We have buckets of stocks, bonds, international stocks, domestic stocks, whatever it happens to be, and each one then works within its own specific bucket. Okay. And then the question is, how much of the bucket called domestic stock should we have as a portfolio allocation? How much in terms of domestic bonds should we have? That bucket, etc., etc. And how did we used to come up with an answer for that? And we all know this, guys. We used to go with a mean variance MVO approach, and the MVO approach would come and say, you know what? You should have 30% of this, 20% of that. And it gave us the word I think someone used a little bit earlier was an optimized portfolio. Okay, there we go. And it said, I'm not going to spend too much more time over there. Okay, when I now come and look at TPA, and where people might find TPA, total portfolio approach, a little bit challenging is that it's new. So we don't have that much in the way, guys, of formal definitions of exactly what it is. Okay. Exactly, remember MVO has been around forever. Okay. So let's be fair to TPA as well. Okay. And if I just take you down, I'm just going to move down a little bit over here. We'll start here. Okay. Number one, when we talk about the dimensions, because we don't have a specific formal definition for TPA, we then work within a bit of a guideline. Okay. And we talk about its four primary dimensions. Dimension number one is governance. Okay. And in terms of the governance process, the key party over here is the CIO, the Chief Investment Officer, and his team as well. Okay. And we don't under TPA, we don't work with a comprehensive asset allocation target. Okay. And what this does for us, as opposed to saying, you know what, you need to spend 20% in stocks, 30% in bonds, and blah, blah, blah. We don't do that with TPA. Okay. TPA says, you know what, we're going to spend more time talking about investment opportunities without the constraint of asset buckets. I don't need to, if you had to say, well, look, what would MVO tell you? MVO would say to you, you know what, you need, here is your stocks bucket, there is your bond bucket, you need 50% of each. And that MVO would tell you is what, guys? An optimized portfolio. TPA comes and says, no, I'm not interested. TPA comes and says, I want the best overall total portfolio. Okay. And it doesn't mean, and that's why it gets a little bit complicated. It doesn't mean that TPA doesn't throw MVO out. Okay, that would be a bit of a misnomer. Okay, but what happens is the board, etc., they say, well, we've got what we call a reference portfolio. A reference portfolio talks about, well, you know what? For this particular portfolio, I want a certain return target. I want a certain risk threshold, etc., etc. Okay, and just to give you an example over here, we may be looking at a specific reference portfolio, and that portfolio, in terms of the return that I want and the risk that I'm prepared to take on, would be represented generally by a 70% global equity and a 30% global bond index. Okay, and you may say, oh, doesn't that look a little bit like MVO? Well, then remember I said that TPA cannot dispense completely with MVO, but it gives you much more, and I think this is much more flexibility to the team. When we talk about the team, who am I talking about, guys? The Chief Investment Officer. The board comes and says, here's a bit of a reference portfolio. We want to be making sure we earn this return with this level of risk. Sort it out, Mr. Chief Investment Officer. Okay. That's point number one. That's governance. Okay. So the board doesn't tell them what they must invest in. Okay. The board just gives them what? And this is key. The board just says, here are your total portfolio objectives. 15% return over 5 years with a standard deviation measure of blah, blah, blah. Okay. And then tells the investment team, it's up to you to construct and allocate such a portfolio. Okay, but not telling them what to do with it. This is a reference for you, so they're not working in the shooting in the dark. And with this reference, this is what we want you to achieve. Okay. An important concept, guys. Whenever you see the word factor lens will tell you that you're dealing with what? TPA. Okay. And again, TPA looks at the drivers of risk and return via what we call the factor lens. The factor lens starts off and says, well, hold on. What level of risk does this particular portfolio want? Remembering, and what we call that, guys, that's called the reference portfolio. Okay. And that's the starting point then for the TPA framework. I said, well, how much risk can we take? We look at it through what we call the factor lens. How much risk can we take on for this particular portfolio? Okay, here's your key. Look at this one. Competition for capital. Now, it should almost, for those that have been around for a while in the older systems, should bring you back a little bit to what we remember the older capital budgeting. When you were looking to budget for a particular project, and then you would look to see which project generated the highest net present value, or sometimes the highest IRR. It's a similar concept over here when we talk about a competition for capital, okay, that each unit of portfolio allocation has got to earn its place. Okay, so if we come to the table, the whole TPA team. Now, who is the whole TPA team? Well, everybody working underneath the Chief Investment Officer, and we have ourselves a meeting. And one guy says, I've got this most fantastic portfolio with these particular return and risk attributes. Another guy will say, hold on a second, okay, that is lovely, and that fits into a specific I've got a better use of our capital where we can earn a higher return with perhaps the same level of risk. So every dollar, okay, of a capital, when we call it each marginal dollar, is then spent in the most optimal, because you don't invest another dollar unless that is the best. As we stand right now, that is the best place to put that particular dollar, given risk and return requirements for the portfolio. Okay, and that's called competition for capital. Okay, in terms of culture, okay, there's a complete culture shift over here, because remember, if the entire team, and the purpose of TPA is to find the best investments overall, we've all got to work together now. It's not a case, and what you find over here, the word that you will not see with TPA is bucketing, because bucketing is a good old MVO approach where we say, okay, here's your stocks. The stocks team, they work on their own. We don't talk to each other. I'm not interested. You've got a 50% allocation. Take your 50% and do with it whatever you like. And the reason is because I'm not talking to you because I'm in the bond team. And the bond team doesn't talk to the stocks team. We're completely different. We are in different buckets, silos, things like that. TPA says, no, we all work together to find the best possible outcomes, the best possible allocation per dollar, the optimal allocation per dollar. Okay. And now, it's often what they say is when an investment team wants to move, let's say, for example, away from the old MVO approach and they want to move towards something like a TPA approach, okay, it often requires a complete realignment of the investment team structure, okay. And interesting enough as well, your compensation frameworks, everyone will be compensated differently now. And the reason being, of course, is because, okay, we're now working together, okay. And it would be quite, okay, I don't know how you would say it, but if you're not a team player, okay, this is not for you. Okay, does that make sense, guys? Okay, so just remember that this is a team approach, a flexible approach, an agile approach. MVO works in a slightly different way in that they're looking much more to try and optimize each one's particular bucket. So if you do well in your, for example, you could get yourself a fat bonus on the stock section, okay, just by virtue of the fact that your stocks performed well, okay. But the other sections performed better than you. Doesn't matter, okay. You were given a target in stocks. You met your target. You achieve your goals, okay. And that's obviously the big difference over here, okay. And if you have a look at when you construct a portfolio, how does it differ, for example, if you are if you've adopted, okay, TPA? And remember, whenever you think about TPA, yes, it's new, but think about TPA as opposed to, okay, the old MVO approach. Does that make sense, guys? Okay. And how does it differ? Increased delegation from the board to the investment team. And all the board will tell you, the board will come out and say, listen, guys, we want you to make sure you get a certain return, certain risk, sort it out. Okay. Look over here. Total fund goals are prioritized over individual asset classes and relative value benchmarks. So we're looking at the whole portfolio. Stocks not as a standalone, bonds not as a standalone, the overall portfolio as a total return. Investment frameworks and processes support greater dynamism, okay? Because you remember, anybody in the team, everybody's welcome, okay? And everyone on the team gets together. And what do they say? You know what? I found this fantastic investment in real estate. It's got tax benefits. It's got this benefit. It's got that benefits. Lower risk, high return. Blah blah blah. And you bring that to the team, and you should get a very good response in a TPA environment. Maybe not so in an MVO approach, because in an MVO approach, they'll say to you, we've got our full allocation already for fixed income. Okay. A collaborative one-team culture is fostered. So that's the key over here, guys, is that we look at a complete, flexible, collaborative team, etc., etc. Okay, and now we look over here just on top of page 5, and we're going to conclude with this over here, guys. We will now move then on to topic 3. But just to conclude topic 2, and hopefully we've given you a bit of a look as to what TPA is. Okay, SAA, strategic asset allocation, and of course, what's one of the key? Where does SAA come from, guys? Okay, SAA, of course, is the good old MVO approach. Okay. So SAA would look at, I've given you a benchmark, you must achieve your benchmark. TPA says, no, total portfolio goals. That's all I'm interested in. Success outcomes is relative. Again, TPA talks about it, and always you can see the words for TPA, total, am I right? Always total portfolio return, total risk, total. Investment opportunity lens. The old SAA or MVO looks at what? Each asset class is separate. TPA says, hold on a second, what can you contribute to the total portfolio outcome? That's what I'm interested in. Okay. Means of diversification, SAA MVO uses asset classes. In other words, let me add another asset class to the portfolio that will perhaps improve diversification. TPA said, I'm just looking at risk factors. That'll help me. Okay. The allocation process is centered around the board. And for TPA, it is centered around the CIO, the Chief Investment Officer. In terms of portfolio management, buckets or siloed teams for SAA, and a one-team approach for TPA. Okay. Guys, any questions on TPA? It's a lovely section. Okay. Not too crazy, not too difficult, but it's new. Okay. Having said that, is that going to be your major focus of questioning? No idea. Okay. I can just tell you that it's new. Okay. Any questions, guys? Is TPA hopefully a little bit not demystified, because it's not a crazy difficult section, but is everybody a little bit more comfortable than surrounding TPA? Any questions? Okay. On that note, guys, what I want to do is I'm going to move on a little bit, and what I want to handle next is another new section that is introduced. I'm just trying to see where that is, if memory serves us, in topic 3.3. Okay. Again, guys, if you've got the notes with you, please feel free to open them up. If not, they will be in front of you here anyway. Reading 3.3, applied benchmarking. Okay. And I had one guy phone me a week or so back and has failed CAIA level 2. Okay. I was pleased to say that he wasn't one of my students. Not that my students never fail, but we do have a very high pass rate. Okay. And he said to me, he studied so hard and he just didn't. And I said, so part of the problem, okay, guys, is when you get into the studies, people just start to study. Take a moment, pull yourself out of the study section and say, hold on a second, where am I? Okay. And let's take a look. What am I actually studying? Okay. Oh, it's applied benchmarking. What does that mean? Okay. And try get a bit of a bigger view of what you are studying, understand what you are studying, and just get a bit because remember, if you can put the context into place of where you are, it just makes everything so much easier just to slot the remaining pieces in because you know where you are. Okay. So if we have a look over here, we're in topic 3, risk and risk management. Remembering again, if we go one step up, what's one step up, guys? One step up is what? CAIA level 2. What's CAIA level 2? CAIA level 2 is all about allocating the portfolio. It's all about portfolio allocation. Okay. So I've got my portfolio. I'm looking to allocate my portfolio. I'm looking in terms of risk and risk management. One of the things I'm looking to do is applied benchmarking. Now, if we just take a step back and you say to yourself, hold on a second, what is this concept then of benchmarking? Now, remember, benchmarking is if you just take one step back and you say to yourself, hold on a second, if you hired yourself an equities manager, okay, and you said to the equities manager, okay, the equities manager says, well, what do you want me to invest in? I don't mind. You say, but it must be equities. And he says to you, can I invest in anything? Yeah. Okay. So I got myself an equities manager and he can invest in anything equity. Okay. We ask ourselves the question here, guys, is has he been successful? I'll tell you an interesting and amusing one. I had a student going back many, many years that phoned me in a frantic mood. I said, what's wrong? No, they gave their money to a wealth manager to manage for them. And last year, the wealth manager only made 1%. That's terrible. That's the worst performance he's ever seen, blah, 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 blah. So I said, okay, slow down. What was the wealth manager's mandate? He could do whatever he liked. Okay. So I said to him, well, let's just stop for a second and let's see what the market, because he could invest in anything he liked. Now, remember, the minute you tell him a manager he could invest in anything else, to be fair to the managers, we've got to be fair, guys. To be fair to the managers, what do we say to them? Here is what I want you to earn. Here's a benchmark. Okay, whatever it happens to be. And then we're going to compare what? Your performance to the benchmark, to what you were supposed to earn, what you could have earned, call it whatever you like. Okay, but remember, it's only fair to the manager if you give him some kind of comparison, something to work with. Okay, so I said, let's have a look at this particular guy's performance. He made 1% for the year. That particular, I don't recall which year it was. I'm sure you guys are more au fait with the market. The market lost money, had negative returns. So I said to this person, I said, you know what you should do? He said, what? I said, no. You should go buy him a bottle of whiskey or whatever he drinks. Chocolates, if that's what he eats. I said, because he's done very well for you. But he only earned 1%. I said, he's earned 1%, but the market lost 10. He's made 11. Okay. And that's benchmarking, guys. Benchmarking is we've got to be able to tell our manager what we want them to earn, what we are going to measure them up against. And then once they have earned their actual return, we're going to say, okay, hold on a second. Let's see if you've done well or not. Everybody with me? The challenge that we've got, and remember again, where are we? We're in alternatives. It's very, if I say to you, do me a favor, and I want to check the chat because you guys are much smarter than me at this because I'm sure everybody's in the markets. I don't trade much in the markets. I prepare notes and videos. Okay, I love what I do. If I just say to you guys, okay, you could invest in anything equity. What's your benchmark? Give me some benchmarks, guys. I'm checking my chat. What are some of the benchmarks that we could compare to? I got one in mind, but I don't know if it's exactly the right one, but I'll wait to hear from you guys. What's a good equity? And I said, you guys, you can invest in it. Yazid, you got mine as well, the S&P 500. Okay. Amit, I like it as well. Total return index. Anything equity. Okay. And Bill, I like yours as well. The Morgan Stanley. Okay. MSCI. They use that quite a lot as well. I agree with that. Okay. So there we go. Easy. Okay. And could you go so wrong if you picked S&P? Different returns, but okay. When I now come to alternative investments, I say to you guys, listen, hold on a second. Okay, we are investing in private equity, private markets. What's the benchmark? Very difficult because there's very little in the way, and hence the term, of course. Okay, I'm not. This was a message sent to me directly, so I won't mention the name. I'll whatever Preqin gives you. Yeah, Preqin is I don't know if you guys are familiar with Preqin. Okay, they are the big collector of alternative data, return series, things like that as well. So yeah, but you take as mentioned, you take your chances. Okay, that's true. Okay. I've got to be a bit careful because we do have quite a couple of students from Preqin on our courses. So, but generally we get a lot of good feedback there as well. Okay, so guys, just in terms of when I now look at alternatives, it's not as easy to get a benchmark. Okay, now now after all of that, now we can start the reading. Now we're going to say, hold on a second. Now I'm looking to try and find benchmarks. And if you just have a quick look at this particular reading, look at this one. Okay, I'm looking to get benchmarks for commodities. And then there's a whole batch of stuff on there. I'm looking to get benchmarks for futures. I'm looking to get benchmarks for private equity funds, real estate. But can you see what, and once you understand your context, everything else after that becomes quite a lot easier because you can fit everything into place. What I want to do, I want to spend time on the new stuff. Okay. And again, is it covered in the notes? Of course it is. Everything's covered in the notes. But I just want to make sure that we understand it nice and clearly. And I'm going to spend a bit of time on 333. Okay. If you're following on with me, guys, we are looking how to benchmark private equity funds. And there's been a new introduction to the material. Okay. It wasn't easy before. And then they went ahead and added something else new in over here. Okay. We start off and we talk about listed asset benchmarks. And of course, we've got all the nice easy stuff there, what we could use. They mention a private equity index, the LPX 50. Okay. Another reason, by the way, and it's very prevalent, of course, with private equity funds as well as hedge funds, particularly, is and I feel for anybody trying to collect data, guys, it's a nightmare. Why? Because particularly the hedge fund guys, they don't want you to know their strategy. They don't want you to know their returns. Unless it's been a fantastic year, you might just get out of them what returns they earned. And then you say to them, hold on a second, those are fantastic returns. Can you tell me what you invested in? Because we're trying to build a benchmark, peer group, call it what you wish. That's as much detail as you're going to get. The conversation's over because they don't want to share. And of course, they don't want to share because that's their proprietary information. Okay. So one of the ways that we can benchmark private equity, the very first one is called the PME. Okay. And we're going to work with two specific PME methods. Now, when you look at the PME method, guys, look at the words. Okay. And again, just a study strategy, guys. Please don't be learning stuff off by heart. When you see PME, understand what it is: public market equivalent. In other words, what am I doing? I've got my cash flows. I've got my returns. I'm a private equity player. I've got my fund. I know what I earned. And most of the time, guys, okay, those returns are, I'm specifically not opening up the discussion for is IRR the best methodology to calculate and to show IRR to show returns for private equity funds. That's a discussion for another day. Okay, we've got plenty of IRR coming up in topic 5, if memory serves. Okay, so you go to the private equity fund and he says, listen, here's my IRR. Is that a good return relative to the returns on the market? So we know what we're going to do. I'm going to take your private equity returns and I'm going to make them what? Public market equivalent. So what I then do is I take the private equity cash flows and I convert them into public cash flows again. And you can see over here, there's the Morgan Stanley Capital, one of the more commonly used external public benchmarks that we use. It's a public equity benchmark. Okay. And guys, I want to introduce you to two different methodologies that we're going to use. In fact, there's 3. We're going to focus on 2. One of them is brand new for 2025. So if you did this in 24, guys, just be mindful this is something new. Let's get going. Okay. Number 1 is the PME long nickels. You guys, you from now on, you're going to just see it as LN. Does it make a difference if you know exactly that it's long nickels or not? Not overly. It's method 1. Okay. And follow on best you can. Okay. It's a bit of an odd method. I'm being kind. Not my favorite, but not for me to disparage it, but not an easy one to work with. We work with what's called a hypothetical investment. Okay. Now, remember, first and foremost, what would I tell you? I would tell you, here is my private equity fund. Here it is. There's my private equity fund. Everybody comfortable? My private equity fund did as follows. Year 1, year 0, the limited partner put in how much? 100. Year 1, they put in another 20, and there was distributions of 90, and the fund is still ongoing, and that's why, of course, at the end of year number 3, there's the fund hasn't ceased to exist. There's no further distributions. That is just the fund's net asset value. Everybody comfortable? Okay, so I hope, guys, and I hope you can do this quick. Okay, do this on your calculators. I hope everyone's very familiar with that and come out with an IRR for the fund. And if you had to show me these numbers, guys, and just very briefly, it's nice, and just also try and work as intuitively as you can. Cash out of 100, cash out of 20, cash in of 390, you're going to have a very positive and a very high IRR. You can just see that intuitively, even though, yes, the cash flows come later on, the positive cash flows, but you can see this is going to be quite a high level of positive cash flow. Everybody comfortable? Okay. And you run over here, top of page 7, I'm over the page, and you calculate the IRR of the investment. 57.74. And what would you say? Everybody's clapping and the whole private equity world is excited and happy. This is a winner. Okay. Now, let's just say, for example, now, okay, what we do, and the big question is this 57.74% any good? Because you know what? Maybe, well, I don't have a great benchmark to compare this to, but maybe, just maybe, if I compared this to the public market, what the public market did in these 3 years, maybe they did better than me. It's all very well that I earned 57.74% IRR, but maybe I would have done better in the market. We do our comparison as follows. Okay, look over here. So I go to the market and I say, market, what did you do? And the market says, I started off at 100 in year 0, 25 in year 1. What did you tell me, guys? Everyone can see that. That's a 25% negative downward move in year 1. The market moved from 75 to 110 in year number 2. That's a 47% increase. And then in year 3, it went from 110 to 120, which is a 9% increase. Okay. And again, this is the market. Which market? Obviously, in this particular example, I'm working with Morgan Stanley index. Everybody comfortable with that? Okay. Step 2. Let's have a look. Guys, if at any point I lose you, someone just scream and shout, don't feel shy. Not an easy calculation. Okay. Look what I do in step number 3. I start to create what's called a hypothetical market account. This is the key. Okay. Look what we do over here. Is everybody comfortable, okay, that in year number 0, cash outflow was 100? Okay, if cash outflow was 100, what's the value of my account? It's $100 because I've spent $100. What have I got? I'm worth $100. Is everyone comfortable? As a fund, I've spent 100. What's it worth? It's worth 100. What happened in year number 1? Let's do some maths over here. In year number 1, what happened, guys? My $100 from here, everyone comfortable? It lost $25. Why did it lose $25? Because the market dropped by 25%. Everyone comfortable? So my investment is worth what? 75. But then what did I do, guys? I spent another 20. So is everyone comfortable? I've now spent 100. I've now spent another 20. My investment account should be sitting at 95. Okay, there's the 95. There's the 95. Everybody comfortable so far? Okay. If I then have to say to you guys, okay, let's move along a little bit, and let's see, I'm going to get rid of that. What happens in year number 2? So my investment started off at year number 2 at 95. Is everybody comfortable with that? What did the investments grow? In year number 2, my 95 grew times by 1.47. Why 1.47? Everybody comfortable that the investment grew by 47. The public market grew by 47. So roundabout that sits at my new investment, sits at what, guys? 139.65. Everybody comfortable with that? But then what, guys? What did I do in year number 2? I paid out $90 in terms of a distribution. Take the $90 off, and I'm sitting at around about 49. I'm not working with exact numbers, but there is my 49 value over there. Is everybody comfortable? Okay, everybody comfortable? Any questions? And by the way, up until now, I'm just running numbers with a key purpose of the final year. The final year is my key year. So let's go and work on my finals. Is everybody comfortable? As I start my final year, my investment account sits at $49. And what have I called this, guys? Why is it called a hypothetical account? Because I'm taking my private equity cash flows, my $100 spent in year 0, my $20 spent in year 1, and my $90 distribution in year 2. And what am I doing? I'm benchmarking those. I'm making as if they were invested where? In the public market. Everybody comfortable? I then take my $49.33 over here. That was the opening balance in year number closing value number 2. And what happened, guys? That grew around about 9%. Okay, here's the 9% growth. There's the 9%. Everyone comfortable? Is everybody comfortable if I had to take my $49.33, which is that number over there, and grow it by approximately 9%? I get to around about $53.70. I'm getting 78 on my calculator. Something like that, roundabout. Everyone comfortable? Okay. Then what I do? Okay. Well, you can see that they're getting to 53.82. Okay. Then I deduct the 300 minus the 300, because remember, we treat the 300 like we treated the distribution over there, almost as if it's a cash inflow, and I get to a value of negative 246.18. Okay, and that is that number over there. Is everybody comes? So just if we had to summarize our process, guys, what am I doing? What I'm saying to you guys is you run your accounts, you run your private accounts. What are my private accounts? My private cash flows. Here they are. I run my private cash flows. Okay, I take those and I grow them and I move them around with the market returns. Okay, so my $100 that I invested became whatever. I then invested another $20. That became whatever. But then I paid out $90. So that was a reduction. And then we reduce it also by the NAV. Can everybody see how I got to my final number here of $246.18? Okay. Good. Okay. Everyone comfortable? Now what I do? Okay. I take my final numbers over here, guys. Okay. And now I'm ready to run another RRR. Okay. This RRR is based on the hypothetical cash flows. So minus 100, minus 20, and plus 90. So, but hold on a second. I've done all this work, and these numbers, where are these from? They're exactly these same numbers up front here, aren't I? I'll color them in the same colors for you. There's the minus 100, there's the minus 20, and there's the 90. Those numbers don't change. Why don't they change? Those are actual cash flows. What was my whole purpose of doing these hypothetical accounts? Was to get to that number. Okay, the 53.82. Okay, that was my whole process. Now I run my numbers again, and lo and behold, look at my RR. When I run my new RR on the hypothetical cash flows, I get to 8.56. What did I get before? Take you back up here. Remember what I got before? 57.7. So what would you tell me? You'd say to me, hold on a second, when I take those same very cash flows from our private equity fund and I benchmark them to a public index, it shows a bit of a different, it's still a positive RRR. Have I done well? Yes, but not quite as well as perhaps you would have thought had you just kept them as they were without trying to do some kind of what we call a PME, a public market equivalent. Okay, because when I make them a public market equivalent, what have I got now, guys? 8.56. Is everybody comfortable with that? Okay. Any questions? Okay. And would you say I've been successful or not? Yeah, I've been successful. Everybody comfortable? Okay. Good. I'm not going to spend a whole batch of this. Is also from 2024. No change over here. I'll just mention this very briefly before we move into the third approach for public market equivalence. And this third approach then is also a new approach for 2025. Okay. And this particular approach, okay, method number 2, instead of working with the actual numbers, remember, this is also the Long-Nichols approach as well. So that you can see the methodology is going to be carbon copy of what we saw previously. Okay, but all I'm doing over here, guys, is instead of working with actual numbers, I work with units. So what I say, what was my investment worth? My investment was worth, I invested 100 over a value of 100, an index value of 100. What's my first amount worth? That's worth 1. Okay. And every single thing I do after that, I just work in index values, units. Okay. 1 unit, 0.2 units, etc., etc. Okay. Everyone can, and we'll get to the same, by the way, you'll get to exactly the same answer. Okay. No difference over here. Okay. As you can see over there, by the time you get to the bottom, your hypothetical cash flows are the same. It's just a different way of getting to them. Here I am using unit values as opposed to using whole numbers like we did in the first example. Okay. What I want to do now, interesting enough, okay, and I'm waiting for the question from somebody, guys, okay, is this the Kaplan that we know, the prep provider? Okay. No. Okay. I have been asked before, by the way, guys, as a prep provider, as someone once asked me, are my notes, okay, compatible, are my notes compliant with Schweizer notes? So I said, no, we're the same as Schweizer. We're in fact also a prep provider. I was very respectful, of course, as always. We should always be. But yeah, we do have a lot about our competitors. Okay, so which Kaplan is this, guys? This Kaplan is, okay, I don't know how you pronounce this, okay, but again, just like with long nickels, it abbreviates to LN. Just be careful if you see it in an exam, guys, it abbreviates to KS, Kaplan Shaw. Everyone comfortable with that? So just watch for that one, just in case you get that in your exam. Okay, good. And the big question is why did we need the Kaplan approach, the KS approach, when we had the long nickels approach anyway? Okay. As you saw, the long nickels approach, the key behind the long nickels approach was what, guys? The hypothetical account, which was on some level not that intuitive. Okay. What we do here in the Kaplan Shaw approach is we work with the NAV as well. Okay. As part of my accumulated values, what I want to do is I want to do a nice example of this one together with you. Okay. And people say, like, how do these private equity guys make so much money? And I say to people, private equity guys work on a very simplistic basis. Okay. There are calls, which calls are what, guys? Calls are the amount of money that they draw down from their limited partners or the investors. And they make distributions. The model is mind-numbingly simple, not a complex model. So if you look over here, guys, we've got calls and we've got distribution. So if I had to let's look over here, guys. Okay. There are my private equity cash flows. Is everybody comfortable with that? When I look at the private equity cash flows, what would you tell me, guys? Nice and easy, nothing crazy. I've got here, I'm going to put them in yellow. Here are my calls. I asked for $100 from my limited partners in year 0. And in year 2, I asked for another $400, probably to make another investment. Everybody comfortable? Okay. Then we look over here, and nothing happens in year 3. Nothing happens in year 4. Year 5, I make a nice big distribution of $525. And in year 8, the period that I'm looking at, I believe I've got a net asset value of 150, but can you see I treat the net asset value as what, guys? As a distribution. Okay. Everybody comfortable? Again, guys, here is my index. I'm working with the Morgan Stanley again, nice and easy. Okay. It's just okay. And there's the market returns. In year 1, it made 5%. Year 2, it lost a bit, blah, 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 blah. But can you see I've got a running percentage returns on my Morgan Stanley over the particular period. Is everybody comfortable? Okay. And all that we do in this model, simple. The Kaplan-Shaw model is nice and simple. All that it does is it says, take your calls. Yes, we're still going to call them hypothetical calls, hypothetical. And says, take those calls and just grow them. Is everybody comfortable? So my $100 over here, what happened to that? In year one, what was the market return? 5%. So at the end of year one, what's it worth? 105. Easy. Then what happened? Oh no. Okay. In year two, it lost 15%. So the 105, let's just see, let's prove the numbers, guys. What happens in year number two? That 105 lost 15%. Everyone comfortable? And that's worth, that 105 is now worth what, guys? 89.25. Is everybody comfortable? So again, just a quick summary. We started off, let's clean up. We started off with $100. We grew that by 5%. Then we reduced it by 15% for year two's market, taking me to a value then of what, guys? $89.25. But then what happened? Then I invested another 400. So let's add that on. Is everybody comfortable that my value then is 489.25? And that is the same number. There's 489.25. And there it is as well. And you keep going year after year after year. And what do we see? At the end of the 8 years after adjusting for market return every year, those two amounts, and if I say, well, which two amounts? The initial $100 invested, the subsequent $400. What is that now worth, guys? It's worth $714.88 after adjusting for the public market. Everyone comfortable? Then I go and do exactly the same thing, and you can see if I just clean up over here a little bit, I'm going to go and do exactly the same thing then for what? For the distributions. But you see what happened with the distributions. The first one only happened in year number 5. Nothing. So yes, we start off my distributions, 525. Then what happened in the very first year of the distribution, which in fact is year number 6, that 525 grew by 10%. So we go 525 and we grow it by 10%. That gives me the 577. We grow that then by 15%, which is takes me then to the 664. And then I add on at the end what, guys? My 150 as well. Okay. To that, and I get to 880. Is everybody can say all I'm doing, and interesting enough, this approach is a little bit more intuitive. What does this approach tell you guys? What this approach does is it takes each and every one of there's only 2 cash flows in a private equity fund. There are calls with a limited partner, and there are distributions. And remember, within the distributions, okay, I'm including my net asset value in there as well. Everyone comfortable with that? Okay, so when I look at those particular numbers, all I'm doing is I'm taking those numbers and now I can create hypothetical accounts. Okay, and look what I do. I've got a hypothetical value for my distributions or stroke NAV, which is how much, guys? 880. And I've also got a hypothetical value for my calls, which is 714. Let's take a question. Okay. Kate, always remember there's no dumb questions. Okay. The dumb question is the one that remains unasked. Okay. And then you think about that and it comes up in the exam and then you wonder, why didn't I ask that? Please feel free, guys. Ask any questions that you like. Okay. And Caton asks, I'm adding the PE cash flows even if they are negative. So you can see over there, in our particular case, all are, so these P cash, we treat them as negative. But why do we treat those particular ones as negative? And the reasons for those is because those are, okay, what we call the calls. So when I call them down from my limited partner, remember when you're looking to do an IRR calculation, we treat those as cash outflows. I've got to pay those back. Okay, those those go back to the limited partner. So we treat those as cash outflows, or looking at it from another point of view, investments made into portfolio companies. Okay, I'm not exactly sure which way we're looking over here, but it seems over here this would be the reason we treat it as a cash outflow when I'm looking at the fund itself. The fund made investments into. So if you wanted to track the flow, Kate, let me just show you the flow. The flow in any kind of a private equity fund is as follows. Remember, guys, you've got limited partners. General partners, limited partners, always are going to be your investors, your general partner. Okay. They are the manager of the fund. Is everybody comfortable with that? Okay. And let's just say, for example, $100, and then, okay, over here, what should I have? I would have my fund managed by the by the general partner and invested in over there by the limited partner. So let's just say, for example, let's just track the flow. So what happened? Let's say, for example, the limited partner has committed, I'm going to call it CC, committed capital of 200. The private equity fund phones them up and says, hold on a second, I need $100 to make an investment. They put the $100 into the private equity fund, and now their commitment is only $100 left. That's what they still have to commit to the fund. The private equity fund, and this is what we're looking at, their cash flows, the private equity fund will take that. Why did they call for $100, guys, from the limited partner? Because they wanted to make an investment. So time period 0, the private equity fund's cash flows would be minus 100. Then the fund is doing fantastically well and they're making tons and tons of money. So in year number 1, they make a distribution back, okay, to the private equity fund, and which will then flow through to the various parties at the top of 200. Can you see how it works? So remember, when we look over here and we're talking about negative cash flows, why is it a negative cash flow? It's a negative cash flow because the fund made an investment. But when the fund made an investment of 100, yes, we all know that that's still worth 100 in my account, isn't it? That's the value of the investment. If you had to, for example, make an investment in an equity, well, that'll be a negative of your account, won't it? You have to pay that. But your account, your equity account is worth 100. Everybody comfortable? Okay. So when I come now at the end of the particular example, all I do, and this is why this approach is quite fantastic, is all I do is I take my 880.61, and what is that, guys? That is the amount that I've distributed, which includes the value of the net asset value, and I divide that, I'll put that over, okay, the value then of my amount of money that I spent. Of course, the amount of money I spent benchmarked to public returns, which is 714.88. Is everybody comfortable with that? Okay. And now, if the value of your investment, which is your numerator over here, which is your distributions, is greater than the value of your calls, like in our case it is, it's a factor of 1232, we have done very well. In other words, what are we saying in the Kaplan Shaw approach? That even when I benchmark cash flows, even when I benchmark those particular cash flows to public markets, still the value of my distributions is greater than the value of what I am calling for in terms of money and investing into portfolio companies. Everybody comfortable? So there's a question over here. Okay. 880 is just the previous 64, and we add the 150 exactly right. So, Bill, let me just prove you that number quick, guys. It's a very valid question. Okay. So, if I had to say to you guys, where is my numbers coming from? Remember, is my 525. So, I would go 525, and I would add on 10%. So, we go 525, add on 10%. Okay, let's color code things so it makes it a bit easier to see. That 10%. That then becomes 10% becomes 577.50. Okay, that's that number there. Then it grows by 15%. Okay, which if we grow this number by 15%, that becomes 664. Okay, so that's there's 664. Then we grow it by, in the last final year, 10%, which becomes 730. And then we add on the NAV at the end of 150. Should get you as close to 880 as possible. Everybody comes with the calculation. So just remember, of course, guys, what we're assuming over here, that 150 happens when? At the end of the year. Okay, good. Yes, so Bill, you're right. The challenge is I shouldn't give too much away in terms of my notes, but at Edge, you're going to get complete honesty. Got nothing to hide over here. We do these on Excel, particularly these numbers that I pull through to the notes. I pull them through off Excel. So my numbers are quite accurate in terms of decimals and that. But obviously, when I do it with you guys using my calculator in the class, and I assume you as well, will be a little bit off because the numbers would be slightly off depending on but Excel always gets it right, doesn't it? Okay. All right, guys. But is everybody more important than that? Is everybody comfortable, guys, in terms of when we look at these particular numbers, what would be a successful company and what would not be successful? Successful would be when the hypothetical value of your distributions, the 880, is greater than the hypothetical value of your calls. So in other words, any time, guys, that you get a number that's greater than 1 for your KS score, you've done well. And just remember, guys, and this is just something, as you go through the notes, I'm going to talk to you a little bit here again, guys, a little bit about strategy. Okay. How are they going to ask us in the exam? They want to test you Kaplan-Shore. How are they going to ask it? Okay. One of three ways. Way number one is they can make it a theory question. Okay. Remembering, guys, and I'm just being very particular over here. When we look over here in terms of your final exam, always important to remember what's it going to look like. Well, we know this by now. Okay. It's going to be, we call it theory. We can call it quantitative if you like. 70% calculations, and that's a max, eh? Maximum 30% will be calculation. It could be less. Okay. Now, when we look at something like this, it's always important when you look at it, try and get a sense of how they could ask this to you. Let's just clean up here. Okay. Number one, they could keep it theory. How do they keep it theory? They can say to you, I've got two companies. One of them has got a Kaplan-Shore score of 1.50. That's company A. Company private equity fund or company B, it's got a Kaplan-Shore score of 1.7. Which company has performed better than the other? Because remember, we're benchmarking out to a public index. And of course, the answer will be private equity fund or company B because it's got a higher Kaplan KS score. But can you see, guys, what we've done over here is we've kept it completely theoretical. I haven't given you a calculation over here to do. Everyone comfortable? Way number one. Way number two. Okay. Way number two would be to say to you, give you that number. Give you that number and make you calculate the 1, 2, 3, 2. Remember, when they do that to you, what are they doing? They're saying to you, and the question can just be literally a 4-liner. What would the 4-liner say to you? Mr. A is benchmarking a private equity fund A. Presented below are they might give you all of these cash flows. There we go. Why? Complete red herring, no reason whatsoever. And then they say to you at the bottom, they say, here are the actual cash flows. And they say to you, the hypothetical market account for the calls is 714. And the hypothetical market account for the distributions is 880. What is the KS PME? Or they could say to you, has this fund outperformed its benchmark? And again, you would say yes. But this could be a calculation question because they're giving you but again, what do you need to know? You need to know that to calculate the KS, I need the hypothetical calls, the hypothetical distributions. Hypothetical distributions is your numerator. The calls is your denominator, and away you go. Everyone comfortable? Okay. Now I hope I'm not ruining anybody's day. What's the third way they can ask this? The third possible way that they could ask this. Okay. And remember, okay, what the and the only reason I mention this is just to give you a little bit of strategy, guys. Remember that in your final exam, okay, paper number 2 is a constructed response paper. Okay. Now, if paper number 2 is a constructed response paper, okay, question 1 is 10 marks. Question 2 is 10 marks. Question 3 is also 10 marks. That's your whole paper, 30 marks. Is everybody comfortable? In terms of those 30 marks, question 1 comes from where? Topic 8. Question number 2 comes from where? Topic 9. Okay, we know these. Universal investment considerations and emerging topics. They've told us. They've also told us, and I'm just clarifying this for those that might not be aware of it, that in terms of these two topics, topic 8 and topic 9, multiple choice questions, none. Okay, so they're telling you, guys, you've got 9 topics altogether. The topic 8 and 9, your final 2, no MCQs will be coming from there for paper number 1. But hold on a second, when you get to paper number 2, which is constructed response, you're going to get 2 questions. What's the wild card, guys? The wild card is question 3. We don't know where that's coming from. Okay, where could it come from in the constructed response paper? They say to you 3 questions. One's coming from topic 8. One's coming from topic 9. The third one is coming anywhere between topic 1 and topic 7. Now, okay, it's just my feeling. We'll leave it at that. Okay. And the question is, can question 3 mix topics from 1 and 7? Bill, they can, but they don't. Okay. If you had to come out and say to me, what, that third question was such a disaster because they asked some from topic 4, then they moved across back to topic 3, and they moved a little bit all over the show. Yeah, they can. They don't. Okay. But, guys, and I'm just talking a little bit ahead of the game here. Reason being is I get to see a bit further than you guys do because I've done this before. Okay. And topic 8, topic 9, what these are? These are theory. Predominantly, these are theory. Okay. Professionalism. They talk about AI, they talk about Bitcoin, they talk about all this lovely stuff, but predominantly theoretical questions. My strong sense always, guys, is that the third question, which they're going to find from somewhere else, topic 1 to 7, is generally going to be a calculation type question. It fits in nicely with what they say. If it's going to be a calculation question, whenever you see seminars, don't say to yourself, I'm taking you back up here, don't say to yourself, what, this type of question, because guys, if I just say to you multiple choice questions, what's the time? Well, it's 120 minutes. Remember this, guys, to answer 100 MCQs, 72 seconds. No ways can you answer a question like this in 72 seconds. Yes, I agree with you. But they could ask this whole thing as a 3 or 4-parter in the constructed response. And they could say to you, calculate, here are your private equity cash flows, here are your market returns. And this can, in fact, become quite a long question. And this question can, in fact, be one at the end of the day where they're going to ask you just to summarize the position of the fund. Has the fund done well? Has it not done well? Etc., etc. Is everyone comfortable with that? So just whenever, and just a bit of strategy, just to try and keep your thinking about you as you go through the notes, guys, always think to yourself, how could they ask this? This is too big to ask as a MCQ, maybe. But number 1 is they could summarize it and just ask you the last 2 little parts of it. Number 2, as mentioned, they could ask it a bit theoretical. They could give you the 1.232 and say, has this fund outperformed, underperformed, or a neutral? Or remember, you can always find this stuff, guys, where in the constructed response section. And then, yes, these questions can become quite large. Okay. Everyone's still comfortable? The question over here. Well, okay. Question over here, guys. Could there be a question here on the relevance of the benchmark as a constructed response? Okay. For example, using public index against private equity investment to assess the success. For example, would you rather use a P benchmark with a similar strategy? Yazid, they can. Okay. And I hope I haven't told you stuff tonight that's ruined anybody's evening, but I'm going to tell you the truth over here. Okay. What you've asked over here, Yazid, is a lovely question. Okay. But CAIA typically does not ask their constructed response questions like that. Okay. And this is the challenge that I've always had with, and this is why when you speak to your mates and they say to you, constructed response is the hardest section, it's not. Okay. It's really easy. It's probably the easiest section. Why do people battle with constructed response? And why? I can tell you, because if you have a look over here, guys, and I just got someone's results about 2 days ago, and I can tell you where he went wrong, and where he went wrong was constructed response. And how did I know that? Because when I looked at his results, okay, they break down your results per topic, guys. Okay, so when I looked at his results for topic 8 and topic 9, and the only thing that they can ask you for topic 8 and topic 9, guys, is constructed response, no MCQ, and he failed both of those. I know he's failing constructed response. There's no question in my mind. Okay. Having said that, why are people failing it? Okay. Reason people fail it, guys, is they ask, and Yazid, this is a bit of a change that we always had, they don't ask overly intelligent questions there. Okay. No. So if I had to break it down for you guys, look over here. Here's question 1. Question 1, okay, comes from, let's just say, for example, apologies. Okay. Emerging topics. And again, remember, in emerging topics, there are 8 readings. Now look over here. So there's 8 readings altogether. Okay. Now in terms of these 8 readings, guys, okay, Bill, going back to your question, can they ask all over there? They can, but they don't typically ask all over there. So question 1, okay, emerging topics, 8 readings, now for 10 marks. But for 10 marks, you know what they do to you? There's a part A, there's a part B, a part C, a part D, and a part E. Part A is worth 2 marks, part B is worth 2, part C might be 3, D might be 2, E might be 1, and there are your 10 marks. Everybody comfortable with that? Okay. Now, you can see very clearly, Yazid, when you've got these little marks over here, they're not asking you overly detailed questions. And worse than that, they're going to ask you very, very specific questions. Please provide 2 advantages of an open source code system. We're talking a little bit about AI. Please provide the 2 bodies, okay, that protect investors in the US or something like that. The questions are very, very specific. And so you ask yourself the question, hold on a second, if it's so easy, why are people failing it? Because these particular topics, you have to know inside, outside, backwards, and forwards. Because if they can ask you, who are the 2 bodies? What are the 2 advantages? Either you know that or you don't. Okay, it's not hard, but you have to have seen it, you have to have remembered it, you have to take it in, you have to retain it, and be able to put it back onto the paper. Not so for multiple choice. Multiple choice is much easier because the answers are there, so you can recognize them a little bit. Oh, yeah, that makes sense. I've seen that before. Here you've got a blank piece of paper, and they're saying to you, please write down 2 advantages. Now, either you know those or you don't. And that's why I suggest you guys to work very hard on these topics. It's really a case of just being able to memorize and memorize and memorize. Okay. Good. We've got Tim, results is being on the borderline of failure. Okay. Tim, I was dealing with a guy, he just finished his university, and he said to me he wants to do, he was talking about CFA. Okay. And he said to me, he wants to do CFA. he was going to join our CFA level 1 classroom, and he said he's heard that the pass mark is quite high. So I said, the problem with CFA and the problem, the general market perception for is, you come home to your family after having written your university exams and you pass. What does it mean to pass at university? 50%. And I can tell you guys, I've marked university exams. It's not 50, by the way. Okay, it's much closer to 48, 47. They push you through a little bit. Okay. CAIA, CFA, FRM, FTP, all the ones that we do, guys, the pass mark is 70. So people say, oh, shame, you failed that exam. No. Okay. You did very well. You just didn't happen to get 70% for it. Okay. Guys, what Tim is referring to over here is, if I had a copy, I would put it up for you, but I'm not really supposed to have them. Okay. My students do send them to me, but hey, okay. And what that is, guys, is that when you get your results, and I'm sure those that did it for CFA level 1, for CAIA level 1, would have seen that they give you each topic of the topics. CAIA level 1 is 8 topics. CAIA level 2 is 9 topics, and they break them down for you. They say you did above, below, borderline, and generally you've got to get most of your marks over the borderline category into the upper categories to pass this exam. Okay, so not easy. Okay, but yeah, that's typically where the pass marks they're not going to sit. Okay, guys, I see we have run out of time for today. But just an important, I'm going to stop sharing that with you. I want to come back to our main landing page over here. We've got a question over here. Okay, so just always remember, guys. Okay, first and foremost, you hopefully everyone's got the format then of our Zoom sessions. We're here to discuss concepts. Anything that you want to bring to the table, the sessions belong to you. If you want to talk about anything CAIA related, okay, absolute pleasure. Okay. But always remember, guys, if there's something that we haven't covered tonight, if you are not on track where we need to be tonight, and you only end up covering this topic 2 and topic 3 in 2 weeks' time, and you want to ask a question, absolute pleasure. Remember, the channels that we've got are always open. Emails are fine. If you want to WhatsApp questions, that's also fine. But don't feel just because the session is finished, you say, oh, I wish we could have asked that. Oh, I forgot to ask that. Doesn't matter. You can ask it any time that you like. When you remember, just pop me a voice note. I do sleep every now and then. I don't sleep a lot. So if I don't answer your question, I'm either in class, I'm asleep, or I'm preparing notes, but I always do get back to you quite quickly. So please don't stress about that. And if I don't, just ping me a second time and I will jump onto it. All right. On that note, guys, I'm going to wish everybody the most fantastic evening henceforth. Remember, those guys are on our call. Okay, we do not have a call next week, being the 24th of November. We will meet up with you again then, guys, on the 1st of December. Topic 4, which is models. It's it's called methods and models. They've put 2 sections together. It's a big one. There's 7 readings. They're all together. It's on your paces waiting for you guys. Okay, jump in early. It's not an easy one. Interest rate models, fixed income models, equity models, a lot of good stuff over there. Enjoy it most of all. We'll see everybody then again on the 1st of December. Cheers, guys.